The next set of tactical patterns we're going to look at are expectation breakers. Now, I particularly like these because it's a point in the chart where people won't notice unless they understand this style of investing. It's not very obvious to most people. Also, as I mentioned prior, a failed move is usually a fast move. So the whole concept behind the expectation breaker and how we're going to use it is that it's a stock that looks like it's going to break lower. It has all the technical characteristics of a stock that's about to fall, yet it turns around and moves higher. So everyone who was either selling the stock or shorting the stock suddenly realized, like, uh-oh, we got to buy our stock back. And on top of that, once the move begins to accelerate to the upside, you get additional buyers that come back in. So this forcing people back into the stock and drawing in new people really creates a funnel of buying that propels the stock higher relatively quickly. So what I've done is I've compiled 4 different styles of doing this in this category, 4 different patterns, and it's likely going to be a new way of thinking for most people. And so I really think that it would be great if you would explore this idea further and look at the markets from this new angle and really try and piece together in your mind how the market participants are thinking, what's happening to them, and when people are being forced to cover their short or buy back their position they've sold. And this is really the dynamics that drives all of these positions. But I think it's really acute in this example, specifically with the expectation breakers. So the first example I want to look at here is the 50-day moving average bad break recovery. So again, like we spoke in the breakout pattern with the 50-day moving average, the 50-day is really a key indicator, a key moving average. And oftentimes, we'll see later, that's even a sell signal if you break the 50-day average significantly. But many times there'll be a pullback to the 50-day and there'll be a day of significant selling with quite a bit of volume that comes in. Now, the expectation when that happens is that the trend is being broken, sellers are dominating, and we should be going lower from this point on. So taking back the high of that day, of that bar that is breaking the 50-day, completely breaks the expectation of what everybody was thinking. Anyone who sold their position, worried that the 50-day break was going to lead to lower prices, realizes they have to buy their position back. Anyone who sold short is going to want to cover, and everyone who realizes that this was just actually a test of the 50 and not a true break will want to start buying the stock. And so relatively quickly, you see here, once that buy happened above the high of the bad break, you get a very quick move higher. I mean, within 2 days, you have 5 times your risk. And again, with all the other patterns, the way I place my initial stop placement is whatever stock breaks above the high of the bad break, just use the low of that bar as your stop, and you get some really low risk entry points. Here we had a $1 risk, so very quickly you had $5 to the upside. Not long after, you had 30 times your risk, and you can see this stock just kept going. So I mean, looking at this chart here in this uptrend, to think that you could have nailed a really precise buy point off the low bar of this move is fantastic, and the upside happened really quickly. Usually, because the expectation breaker causes such a funnel of buying, as I mentioned before, it's rare that you'll have a lot of backpedaling that goes on. If it's a true expectation breaker, you should get a substantial move rather quickly and rather strongly. Here's another example of Alteryx. So we were consolidating sideways and we pulled back to the 50-day. It was showing actually a lot of relative strength, whereas the market was falling rather strongly here. Alteryx was going just sideways. And we had our bad break of the 50-day. We closed below the average rather strongly. The volume did pick up 37% above average. And you can see what happened here is we also had a mini coil, which we discussed earlier, which is a coil pattern. And once we broke above that bad break high here, we had a really quick move higher. So by placing the stop below that initial low bar, we had only a $3.75 risk, and very quickly we had 5 times our risk. Soon after, we had 16 times our risk. You can see this break of the 50-day moving average is probably what most people expect when it happens, and here we did follow through to the downside. But the fact that here we turned around and we broke above that high, that expectation was broken of the 50-day bad break. So again, a very quick move and a strong move. Another example here is with Netflix. We can see that the stock was moving lower after a significant move higher, and we had a gap right through the 50-day. People were probably really concerned that this was going to move significantly lower, but after just a couple of days sideways, we break higher. And you can see the zoomed in version here of what went on. We broke below, a little bit of follow through, but we had a quick reversal, and we took out the high of that prior day of the 50-day moving average break. Stop would be placed low of the day. We're looking at an initial risk of only $2. Here, the move did take a little more time to develop, but you still had 5 times your risk after a few months. Not as much of a runaway move as others, but your downward stop was never tested. I mean, it was just you broke the prior high of the bad break and you essentially just moved higher from there. This is the trade desk. This is in 2020, we had a bad break here after a significant rally. So we really had been advancing for a number of weeks and months. And we had this bad break with significant volume increase, 80% above average. So everyone's expectation is really for a lower move. But what happens after that bad break bar? We really go sideways for quite some time. And we break above the high of that bar right here. So your initial stop would be the low of that bar. I want to show you how this can be a little messy sometimes, and we're not going to pretend here this is always perfect. But we were stopped out after that break above the prior high. And sometimes there's just a little bit of volatility around an entry. So I would not say it's impossible that you rebuy this again once it takes out the highs after that initial stop. Sometimes around the 50 there's some volatility, so you will see this occur occasionally. If I notice it's just a quick move lower and a retesting of this very large bar, I'll buy a second time. In fact, I tend to, if the breakout bar is a very small range bar, as it was in this case here, I'll tend to use probably the low of the prior day, but just to keep consistent, if your stop is below the low of this day here, you can always be aware for a second re-entry once the bad break bar is taken out again. You had a $2.50 risk on the second attempt. You very quickly had 5 times your risk, and soon after 17 times your risk. The next pattern we're going to look at here is again centered around the 50-day moving average. I really like to use this average here because it's not obvious to most people. You're not buying above highs, and it's really a point of importance for most institutions and individual investors. And so what we're looking at here is kind of different. We're not looking at the taking out of a bad break, but sometimes a stock is living below its 50-day moving average. So it's spending a certain amount of time below the average. We've broken below prior, and it's consolidating, and we have a rally into the 50, but it meets an area of resistance. So the 50-day pushes the stock lower just a little bit more. And what's important here is that after this test of the 50-day moving average, we retrace about a third of the prior move higher. So you hit the 50-day, and there's a significant backing off of the stock. You don't want to just see it hit the 50, pause one day, and then assume that you're breaking higher. You want to see that the 50-day acts like a real point of resistance here. So the fact that we hit the 50-day, we retrace at least a third of this up leg off the lows. When we come back up and take out the high of the bar that was resisted at the 50-day, the expectation that the 50 is still resistance is now broken. This is essentially an expansion on the prior concept of using a bad break, whereas that was surrounded around one day. This is surrounded around several days, or a pattern that develops where the 50-day is showing to be resistance over a number of days or weeks. Again, you could have put your stop below the low of the bar that breaks above that prior high. In this case here, we're looking at Apple back in 2010, so due to all the splits, it looks like a low price stock. In reality, it was much higher priced than that. But in this example here, you have a 12-cent risk, and very quickly you get 5 times your risk, soon after 20 times your risk. This here was the flash crash of 2010, so this is not typical trading action. However, it's good to keep in mind why you have to always keep your risk in check, because these kind of black swan situations can come around. So you always want to be aware of what's going on in the marketplace. So another thing to keep note of was that Apple was showing quite a bit of relative strength here throughout this pattern. You can see we made higher lows in Apple, where the market made lower lows. And so that really added to the underlying strength of the stock and why this would be a setup for you in the first place to be looking at to buy this 50-day moving average resistance failure. Another good example is for Apple again. Again, I'd like to sometimes stick to the same stocks to show you that these same patterns do recur over and over again. We'll see here that Apple was really in a longer-term consolidation, and prior to this big up leg in 2012, we had a rally into the 50-day moving average, which lasted for a few days. We correct about a third or more of the prior up leg. That's why I like to have that condition in there, because you can see if you were to just rally up and use only 1 or 2 days as your resistance point, it's very easy to just kind of get stopped in before the entire consolidation is complete. Once you have that pullback of about a third and we turn back higher and break above the prior high, you have a very controlled risk. You can see here on a zoomed in version, we came in, took out the prior high with this low, small range bar. You can place your stop below the low of that day, which is 20 cents in this case. Very quickly, you have 5 times your risk, and soon after, 44 times your risk. So if you really wait for the right setups and you control your risk, Whereas most people think that, oh, trying to have 5 times your risk is a lofty goal. If you really take the time to focus for the right stocks at the right points and really keep your risk contained, it's really possible to get many multiples of your risk. And that's really what keeps you afloat and keeps you advancing even in choppy markets, because you're not giving back too much when you're wrong, but when you're right, you really take advantage of the situation. Here's F5 Networks back in 2009. And here we have, again, a couple of patterns that come together. We have a 3-touch trend line on this consolidation to the 50-day moving average. And along the way, we came up, we hit the 50, we corrected about more than a third of that rally off the low. And here, this is probably a little less time than you'd normally want to see on a test. But when you combine that with the 3-touch trend line break, it really makes it altogether a very powerful pattern. Also, you'll notice here that on the turnaround, the volume really did pick up. So people really took advantage of that 50-day break and piled in with a lot of buying. You really want to build this mosaic of bringing all of these tools together. You could have put your low below the stop of the day, which is $1.90 risk, and soon after you had 5 times your risk, and a couple of months later, 10 times your risk. And again, it's really always very nice when these different patterns come together to form a buy signal. Here's Nokia back in 1999, and you can see here that we broke below the 50-day, we rallied up to the 50 a couple of times and stalled, so you really knew this was a real area of deep resistance. You can really see it in here. It comes very close on the second touch, but doesn't quite break the first one. And here we retrace more than a third of the uptrend into the 50. When we finally bust through above the prior high, we break out, place our stop below that low, and we come very close to taking out the low of that bar, but we survive in this case here, and we see a significant advance, 5 times our risk relatively quickly, and then we move on to 21 times our risk before the stock goes into its climax top and has an astronomical advance. So again, the whole move kicked off with this really great low risk entry point. So there's 2 patterns left to look at here in the expectation breaker series. This one here is a way to buy near the lows of a pattern. So some people really do like to buy near the low of a pattern and have a hard time buying breakouts. And I can understand that. It's probably more of a psychological pitfall, because as we've seen, breakouts are a great tool, and there's just many different ways you can buy a stock. And I wouldn't really say one is vastly superior to the other. But in this case here, what I like about this is that you really have that point where anyone who went short on a breakdown is really going to be forced to cover, and that usually leads to very quick moves. Also, sometimes when a stock is showing a lot of strength, you can really use this pattern to buy in near the low of that basing structure and give you that big amount of cushion as you add to that stock as the trend unfolds. You typically want to use this stock when it's showing relative strength, or at least no relative weakness. And you can see here the market was going sideways, and so was BlackBerry in this case here. So it wasn't showing any kind of exceptional weakness. You would want to avoid using this pattern if you were to see the market climbing strongly and a stock breaking lower. That would not be the right setup. You want to see a stock mirroring the market or being stronger than the market. So as we approach the 50-day moving average, which we'll see later is a buy point for positions as well, under the right context, we broke a prior low. And the key here is you basically have to start a timer. This is the way I approach it. So the bar that breaks the prior low is indicated here on this bar here. So the next day would be day 1. So from when the stock breaks the prior low, I give it 3 more days to close back above the 3 exponential moving average. So you can see that 3 exponential moving average is here in purple, light purple. It follows the stock relatively closely. The reason I like to use this criteria is twofold. Number one, I give it 3 days, because if we're really experiencing a fake breakdown or just a shakeout of the lows, you should be coming right back into that pattern relatively quickly. If you break lower and pause and never really bounce back up, you're probably just consolidating before you move lower. So the fact that you break the prior lows and come back up within the pattern within 3 days shows that it was really just a shakeout of prior lows, and the real move is going to be going back higher. Very similar to the shakeout plus 10% shaper pattern, very similar logic. And I like to use the 3 exponential moving average because simply using the prior low really causes over trading and a lot of churn as you know, you're just getting in back above the prior low, and there can be some back and forth. So closing above the 3 exponential moving average really triggers the fact that we're coming back into the pattern, and once we close above that average, I use the high of that bar as the entry point. So to go over again quickly, we break the prior low on this bar, and then 3 days later we close above the 3 exponential, and that becomes our entry point the next day if the high of that bar is taken out. So you can see here we had an initial 5.5% risk, and very quickly you had 5 times that risk to the upside, and this stock really exploded higher after that. Here we can see again a similar example. This is Baidu back in 2007. The market was really falling out of bed, and this is the perfect way to really use this pattern. You see the market falling really strongly, and you want to start looking at which stocks are not making new lows or are really going sideways. So this stock was really going sideways during the entire time the market was falling apart. And then right near the low, you just have some sellers finally giving up and breaking the prior low here. And within 3 days, so here within 2 days, you can see this bar here broke the prior low. 2 days later, we close above the 3 exponential moving average, and the high of that bar is our entry. So there was a 4.8% risk. Very soon after, you had 5 times your risk, and not too long after, you had 26 times your risk. So really amazing when these things all come together. We had a nice pullback to the 50-day moving average showing strong relative strength, and people were just shaken out right at the low, only for this to come back up and then start its really fast move higher the other way. Here's Alphabet or Google, a similar type of situation. Stock was really kind of falling out of bed here, and this was kind of trying to hold along this support area until it finally broke lower. So you can see this bar here, this candle is what broke the prior low, and 2 days later we closed back above that 3 exponential moving average. We would have bought above the high of that day right here on this red candle. Our stop placement would have been below the low of the prior day, and you had an initial $5 risk. Very quickly you had 5 times your risk. Soon after that, 24 times your risk. And this is a really nice shaper that formed near the 50-day moving average, and we would have multiple tactical entries to add to this as we moved higher on the right side. To stick with Google again to show another example, as we can see here in 2009, we had pulled back to the 50-day moving average for the first time since this up leg started, which gave it a buyable area. And after testing that 50, we broke lower, and that break lower happened on this green candle right here. 3 days later, we closed back above the 3 exponential moving average and then triggered the next day for a long, and we had an initial $6.25 risk. Soon after, we had 5 times that risk, and you can see the stock really got going after that, and you had many multiples of your risk as the stock trend continued. Another great tactical entry. Here's Zoom Video, one of the big winners of 2020. Again, perfect setup. We ran up, pulled back to our 50-day moving average. I do find these tend to happen around the 50-day, but I wouldn't use them only in that context as long as the stock is showing some strong relative strength. But the fact that we were near the 50-day, we broke the prior low here. You can see what the black line indicates the prior low. We broke the prior low. 2 days later, we closed back above the 3 exponential, triggered long the next day with a stop below the second day to close above the exponential moving average. So we got long on this bar here. Our initial risk was $12. Prior to earnings, you had 5 times your risk, so you had the option to stay in with that kind of a cushion if you wanted to. And with a good earnings report, we ended up having 28 times our risk as this stock got to its eventual high of over $560. This is Zscaler. In 2019, we had a great earnings gap up that really accelerated to the upside. Once we had that normal correction, we formed our first low. We had our second low here right on the 50, which shook out just below the prior low here. The very next day, we closed above that 3 exponential moving average. The high of that bar served as our entry, which we got long on this bar here with an initial $2 risk placed right below the prior candle low. And you can see here, you very quickly had a 5 times your risk move. The last pattern we're going to cover here in terms of expectation breakers is the kicker. So some of these patterns require multiple bars. Some of these patterns are only require 2 bars. And I like that because it really provides the flexibility for you to adapt depending on market conditions. So I like kickers because it's a really pronounced pattern. It's kind of similar to a gap in that it moves fast, yet this typically helps mostly people who are active in the market because any day can really set off a kicker. So there's not a lot of warning as to when it's going to happen. So what is a kicker pattern exactly? Again, you want to use this in the context within a shaper. You want to use it in the context within a 50-day or 10-week moving average pullback. You don't want to just use a kicker anywhere in a stock price. Essentially, you have a rather large candle, red candle, where a red candle really signifies that the close is before the open. So whenever a candle is red, that's what it means. It doesn't mean it's down on the day. It could mean it could be up on the day, but it just means that the close is lower than the open. So once you have a red candle bar, a kicker occurs when you actually open above the prior body. So by opening up above the whole prior body, that means Today's open is greater than yesterday's open. So what's happening here? Basically, the prior day we open up and we sell off throughout the entire trading day. And sellers are really in control. And the next day, not only do we start to move up, but we kind of completely ignore all of the selling that happened the day before and gap right up above the open and all of that selling that took place. So anyone who sold yesterday or went short during that big down session is completely surprised and shocked. And many times when I was a very short-term trader or day trader, if you had a stock closing very weakly on the day, that was a great point if you want to short or remove exposure, especially when there was a lot of momentum to the downside. It was almost I don't want to say a certainty, but it was as close as you'll get in the market that we're going to either open lower or just open slightly higher and sell off again the next day. So a lot of people will really use a weak close and all of that selling to do additional selling or a little bit of shorting going into the day. So whenever you have that strong gap up the next morning, anybody who sold or anybody who was short is really caught off guard and knows that something significant is going on to cause that kind of a gap up after so much selling going on the day before. Something new has come to the marketplace to change the dynamics. Either the market shifted or some kind of new specific came out in the stock. And we'll look here at Baidu again, 2007. This is that same 3 exponential shakeout that we looked at before. And we have that kicker pattern right here at the low. So we kicked higher. The kicker pattern is really easy to use. There's a couple of ways we can do it. I tend to just buy the open if we gap up. If we buy the open, I place my stop at the close of the prior day. So for example, if we close at $20 and we open at $22, I'll buy the gap up, but if we go negative on the day, my whole idea, my whole argument that, all the short sellers are caught and there's something new in the market, that's gone. The stock opened up and sold right off and it's going negative. That means sellers are back in control. So you know relatively quickly if you're wrong. And if you buy on the close of that day, you can simply put your stop at the low of that day. The reason I provide that alternate buy point of buying on the close is that not everyone is available to really watch the market on the open. And as long as you close strong and you close above the open of the prior day and the pattern is still intact, buying on the close is still a strong pattern. And so if you see a stock has gapped up in the morning and a kicker pattern is forming, but you're not there to really take full advantage of it because you're not a full-time investor, well, buying the pattern on the close is still a strong reason to be buying that pattern. And I would just, at that point there, once you're buying it on the close of that day, you don't have to wait for it to go negative. The day is closing, so I would use the low of that day as my stop point. So here in this example, if we bought the opening on Baidu, we had an initial 80-cent risk to the close of the prior day. Very quickly, we had a 5 times risk, and then we went substantially higher. Here we consolidated very shortly. We had another kicker pattern. I wouldn't typically be adding this far from the consolidation, but it's just to prove the point of how powerful this pattern is that we kicked up and we had a strong move higher. But because, again, we were so extended, that's why you're more susceptible to these kind of reversals when you're buying a pattern so extended from a basing structure. But we went sideways and we moved higher. We had also a mini coil here again, this 3-bar pattern. And once again, you can see we had a kicker out of this mini coil. So I really like to see when all of these patterns coalesce together. We had this initial $1.40 risk, very quickly had an 8-fold move compared to your risk. And then we fell over quite strongly again. Again, that's why you'll notice all these patterns I try and indicate are coming out of a consolidation, a shaping base rather than just anywhere along the move. If you're buying this anywhere along the move, you're really using it solely as a swing trading technique and you have to be much quicker to exit. You're not looking to stay in for such a long extended time because you don't have that foundation underneath you of the shaper pattern to propel you so much higher. In this example here, we're going to look at Tesla, and Tesla's been a huge winner for the past couple of years. This is the 2020 advance. And you can see along this advance, we had a number of times we had these great kicker patterns. We had a kicker pattern right here off the 50-day moving average, and we had a kicker pattern here off of this sideways consolidation. And you can see we had a red closing bar, we gapped higher, and you could have bought on the opening or on the close of that bar. You had an initial $19.25 risk. Very quickly you had a 5 times your risk move and then 10 times your risk move. Similar story here. We had a $26 risk. This time it took us a little longer to get to, or 5 times our risk, probably longer than I would like. I probably would have exited myself eventually if there was no upside progress. But the kicker still did indicate the bottom of this consolidation was a great entry point. And eventually we did go much higher. Here is Viva Systems. So here again, I like to see when a number of things come together. And we had the market in a very strong downtrend. You can see here Viva was much stronger and barely making new lows. Also, whereas the market made lower highs here, Viva made higher highs here. So you really have those A-B pattern, those relative strength patterns showing up here. We had a 3 EMA shakeout that took place right along the lows. But after that shakeout, we had one last pullback with a red candle, and we kicked higher. And you can see the pattern really zoomed up here on the upside. You had initial $1.90 risk. Very soon after, you had 19 times your risk. So this really took off to the upside and really just started off with this really small risk. Also, you'll notice if you're starting to get used to these patterns a little bit, besides the relative strength setup, the shaper pattern that was forming, the 3 EMA shakeout, this kicker is also a 50-day moving average volume breakout. We had significant volume come in, and as we kicked through this average. So really, at this point here, Viva really was flagging a number of key conditions for a stock advance to be coming. This is the last example I want to show here. This is Roku, the kicker pattern. So this is this really nice uptrend that we looked at earlier, and you can see this out of this whole uptrend, there were a number of great points you could have entered, and you had a kicker right down here. We had a second kicker, a third kicker, a fourth kicker. And it's just amazing that you could have added to all these points to Roku, a real monster winner in 2020 with a very, very simple pattern. It provides that clear point to know where your bullish thesis is happening and where it fails, and has a rather immediate upside move because with that expectation breaker, there's kind of that funnel of buying that kicks in and moves the stock higher.